Right on. I'll just go ahead and get started. My name is Justin Botillier. I'm CEO of Calyx CPA, based in Medford, Oregon. Been in the cannabis industry for a long time. Pretty much my calling card is dealing with 280E. And I did ask them to change the name because unless you know what 280E is, you probably won't come to this meeting. But those of you who are here probably know what 280E is. So I can go two directions with this. We could talk about mitigating 280E and the approaches, or we could talk about what's rescheduling the cannabis industry and the impact of that on its applicability to the psychedelic space. So how many of you are in a plant-touching business, like trafficking? Trafficking meaning you buy or sell, cultivate, ship, transport a controlled substance. Big hands. 1, 2. All right, and then how many of you are thinking about getting into the space of controlled substances? Okay, well, I think what I'm gonna do is do kind of like a 101 and then maybe a 201 course in dealing in controlled substances. So first of all, okay, so I'm gonna be kind of going off my guide as this. It's like a quick guide that I created. It's pretty informative. It's got a lot of information. And so after we get done here, maybe stop by our booth, 2623, and pick one of these up for information. And if you want us to also maybe contact you after the fact, you can take a picture of your card, and then you can put you on your mailing list and you can get all the updates. And I've been recently, especially with rescheduling cannabis, I'm doing a lot because the implications of moving from a Schedule 1 to a Schedule 3, although not huge in and of itself, it does remove Cannabis from the Controlled Substances Act, or it doesn't remove it, but it removes 280E, and so that tax penalty of 280E no longer applies to a Schedule 3. But it also adds fuel to the fire of the, I guess, the constitutionality of whether or not cannabis in particular should have ever been considered a Controlled Substances Act. And there's a big push by tax attorneys and other professionals in the industry that are now arguing that 280E really shouldn't have applied. We have more of a conservative Supreme Court. Right now, the only holdup is the Supreme Court. Previous to that, it was always Congress's intent to allow sovereignty to the states for their own, the sovereignty of their own drug policies, and Congress, starting with the full memo, kind of implied that, along with defunding the DEA to when the DEA was, or to what would you say, seize assets from like medical companies. So I guess what I'm trying to get at is the Supreme Court overruled Roe versus Wade, which is crazy, and kind of signaling that they're really returning to a more of an originalist interpretation of the Constitution, and therefore do states with their own drug policies who are not allowed to move product over states, are they within the interstate commerce law? So the question is federal persecution of companies and states with their own drug policies violating the interstate commerce clause? And I believe the Supreme Court right now, with 6 conservative Supreme Court justices, would say yes. So when that case gets back into the Supreme Court, the Controlled Substances Act may not apply to states with their own drug policies anymore, and therefore would be illegal in those states at this point, and therefore 280E would not apply. So that's kind of the future of, I think, for the psychedelics industry, once cannabis laws make it back to the Supreme Court, or lawsuits make it back to the Supreme Court and say, hey, we want our money back for all the penalties and taxes that you filed against us. All right. So enough of that. 280E. So what is 280E? So 280E is a tax penalty that essentially makes it, if you're in a trafficking business in cultivation, selling, reselling, if you take possession of a drug on the Controlled Substances Act, Schedule 1, Schedule 2, then you're in a trafficking business. That means, from a cannabis perspective, cultivation, wholesale, dispensaries, retail, that kind of thing. And then in psychedelics, it's the same kind of thing. If you're growing mushrooms, if you're producing product, if you're reselling it, if you're administering it, but if you're touching it, then that kind of pretty much makes you a trafficking company, and therefore 280E would apply. So 280E, interestingly enough, that's a tax penalty that was imposed by Congress in the 80s, and they did it. And you know what's interesting? I went to the Mob Museum yesterday. Have you guys been to the Mob Museum? It was actually very fascinating. If you can make it, go check it out. And at first, when I learned about 280E, I was like, oh, damn them, you know, the government is more part of the institutional racism of like cannabis, and it's all about that. But I didn't realize just how much power the mob had at that time in the 80s still. So this whole war on drugs was not necessarily completely institutional racism like I had kind of thought it was. You know, prohibition of cannabis and all that, that was definitely racist, but 280E may have not been as racist as I had thought it was, because they were taking these guys down for tax evasion, of course. You heard Al Capone. Al Capone went down because of tax evasion, and so they're like, hey, let's make it worse for the mob by throwing in 280E. They're going to rack up a bunch of tax debt because they can't take any of their deductions, and then we're going to be able to put them in jail for that. And so I think that was the origin of 280E. And of course, in the 80s and 90s, they did take down most of the mob and the organized crime in the United States. Did an amazing job, according to the Mob Museum. But yet we're left with 280E. And now states are legalizing, but the Supreme Court says, well, the federal government has the authority to regulate trafficking, or regulate their drug policies across the states, even though it's a purely intrastate business. So 280E is where you are not allowed that, from a tax perspective, to take your deductions. So if you're in a service center or a facility that is administering these substances, then you really can't deduct any expenses, except for maybe the medicine itself. And you know that in this industry in particular, it's not a commodities industry, it's a service industry, right? We're doing service. We're not selling large quantities. Like in cannabis, people can smoke weed all day long, and they consume pounds, you know, over small periods of time. But they're not going to be doing the same thing in the psychedelic space. In the psychedelic space, it's going to be like you're going to get $20 in today's standard, $20 in unregulated. $20 will get you something. It's now like $250 in Oregon. $250 to $400 is going to get you a macro dose that's going to give you a really good session at the service center. The service center can write their cost for that medicine off, but they can't write off anything else. And so if they're hiring facilitators, if they're paying rent for subleasing, if they're, you know, for their front end, for everything, they cannot write any of that off, according to 280E. And, but that's the surface level. That's the surface level understanding. Part of the reason why I'm out here talking to people in Las Vegas is because I'm more about it. I'm just trying to warn you that there are ways to deduct your expenses and to get you down to near legal level business, or the legal business level of tax liability, but you have to look a little closer at the tax code. You have to really understand. So what are some of these methods? First of all, there are two popular ways right now being espoused by tax attorneys, and they're likely the ones that, like these lawyers, the tax attorneys that are setting up your businesses, they're going to be the first step. They're the ones who you talk to first when you set up a business, and then they will also attempt to advise on what's the best entity set up to help you mitigate 280E, and they will almost always talk about this like bifurcation of services and the plant touching part of it. So, like, you're going to have facilitation, a service-based business on one hand, and then you're going to have a plant touching service, the facility and the plant touching business on the other hand. And now, then the patient will pay, or the client will pay the facility company for the service side of it, and then it will pay the service center, the health center, as they're going to call it in Colorado, for the medicine. And the facilities is the facilitation business can deduct all of its expenses. There's no issue there because it's a service, and they should not be touching, the facilitator should not be touching the plant, and therefore it's not subject to 280E. Some people will argue, and some tax attorneys will argue that they are, and you should also be cautious of that. I feel pretty strongly that there's a big defensibility there, including the Champs court case, which was the precedent, I guess, legal precedent on being able to provide services in this space and not be subject to 280E. It's called Californians Helping Alleviate Medical Problems. It was a court case back in, I think, 2006, in which the IRS audited a nonprofit organization that was providing caregiving services while at the same time giving selling their patients weed. And so the IRS came in, stripped their 501c3 status, and then changed their tax returns so that they didn't get to take any of their deductions, and then essentially bankrupted them. They had to go bankrupt to get out of it. Well, they actually came back and they took that case to the tax court, and the tax court ruled in their favor that the expenses associated with the services they were providing are deducted. So that was a big win for the industry. I would say that you in this psychedelic space have a much similar argument that can be made, assuming it goes that far. So that's the bifurcation kind of model, where 280E applies to the sale of the medicine, but it does not apply to the service side of it. Okay, so then there is another way, and this is our preferred way, and we have now started doing tax returns over the last couple of months. We've been doing tax returns for the service centers in Oregon. We work with the first half dozen or so of them right now. And what we're doing with them, and those that actually followed our recommendation versus the tax attorney's recommendation, is we keep it simple. Just under one business. Keep it all under one business. Yes. You're going to keep track of your services. You're going to keep track of your room rent. You're going to keep track of the income that you also are receiving for the sale of medicine. But you don't need to create complex structures. In the cannabis industry, that already failed. Like, it's very difficult to have similar ownership in a couple of different businesses and then have separate bookkeeping and separate banking and separate cash management and make it work without too much like commingling. They really don't, IRS doesn't like commingling. That's like the first thing they look at. If they're commingling, then they jump on it. And they're like, no, there is no difference between these two entities or these three entities. They're all one entity, and they're all going to be subject to 280E, and it's going to undermine your position. So right now, there is no traditional way at this point because none of these places have been taken to tax court yet. And I honestly don't think it's going to go that far. Psychedelics are a little bit more respected, and cannabis has definitely paved the way for better compliance in the psychedelics for the psychedelic space. So we like to keep it simple, and the way we do that is we use what's called 471C. So 471C is a code section that was implemented in the Tax Cuts and Jobs Act, and it essentially made our ability to calculate your inventory, thus your cost of goods sold, which is allowed to be deducted. Cost of goods sold is allowed to be deducted. So again, one is cost of goods sold. There's your gross revenue, which is the money received by your clients. Then there's the cost of doing business, specifically providing the service and or the medicine those costs of goods sold are deductible, and then you've got your overhead expenses. So, in 2018, the IRS made our ability to calculate inventory and cost of goods sold a lot easier by just simply saying, hey, a business, any business, people are not none, can calculate their inventory in any way they see fit, as long as it matches their books and records. The language is that simple. It's not very complicated. It's saying like, hey, if you're in any business, and you're under $29 million gross income, that is what the caveats. If you're over $29 million gross income, you can't use 471C. If you're under it, then you have the ability to use 471C. And as long as your books, if you're including costs that would otherwise be considered like overhead in as like part of the cost of sales, then and in alignment with your books and records, then you can do that. It's totally legal. There is one caveat to that. Okay, so the IRS back in 2018, when the cannabis industry started, we jumped on it, and it's kind of a loophole, we started using it, and then the IRS's governing body I don't know what it stands for, it's like Treasury Secretary something or other, got wind that the cannabis industry was using 471C in order to take more deductions than they otherwise would had historically been allowed. The IRS was pressured to do something about it. And so the IRS put in some regulation. Now you gotta understand, regulation is not tax code. Regulation is the IRS's interpretation of the code. Just like I have to interpret the code when I am filing tax returns, we look to regulation for the IRS's instruction. Like, how do we interpret this code? Regulation is that interpretation. We look at that and we're like, oh, okay, the IRS says we should deal with this in this way, so we're gonna do that. Well, the important part is that the IRS doesn't actually write the tax code, it can only interpret the tax code. So they put down some blanket regulation in response to this pressure they were receiving that if an expense is disallowed by another tax code section, i.e. 280, then you're not allowed to use 471. Okay, so that's literally close to the language that they've said in there. But the important thing is that's regulation. That was their interpretation. And so then the professionals in the industry have been doing this for a while. The tax attorneys that we work with got back to that regulation. They're like, what about this regulation? And where in the tax code does it say this? And like, where does it say that if the deduction is otherwise disallowed by another code section in the tax code, we can't use it? Where is that? It's not there. It doesn't exist. There is nothing in the tax code in 471 or 471C or its predecessor 471A that says that if an expense is not excluded or is excluded by another tax code, you can't use it or you can't deduct it. It doesn't say that anymore. So we never stopped not using 471C, and then it turns out that 4 or 5 years later, the IRS is not touching a 10-foot pole. They're not making adjustments to tax returns for those people who used that code section and quoted it and said, hey, our inventory method is this 471C method, and it's going to be based on the books and records, and therefore we're going to move a lot of costs, the cost of goods sold, and deduct those under 471C. The IRS not disputing that. Okay. So that is I wouldn't say it's bulletproof, but it's a very good way to go. So we're using that for these service centers in Oregon. And what we're doing is we're just saying the same thing. We're like, anything that is necessary for conducting and making transactions in this business, we're inventorying that, and then we're gonna prorate a little bit of that to ending inventory, and then we're gonna deduct all the rest And it's kind of like cost per service or cost per session. We calculate them, do our best, take our best, not our best guess, but our best ability to come up with a methodology that comes up with a reasonable inventory methodology in which we can justify, hey, these are costs of services. Because the IRS knows, well, you are selling drugs. Like that's the IRS's perspective. The IRS's perspective is you are selling drugs. And therefore, if you are selling drugs, which in service centers, that's what you're doing, then what is your cost? There are costs to sell these drugs. And so we can justify using a 471C approach to be able to first capitalize cost inventory and then deduct based on your ending inventory. I won't go into all of that. That's too much, I would say. But that's the approach that we're using, and it works so far. But I can't say that one of those businesses is going to be picked up and audit, and then the 471C methodology eventually be disputed. But I've worked with enough tax attorneys to know that our methodology is very defensible. It's aggressive, but it's very defensible. So what does that mean? Worst case scenario, you don't get to deduct your professional fees and your advertising and maybe some other administrative expenses, but you're going to deduct all your payroll, all your facilitation costs, all of your rent, your facility costs, all of it. You're going to be able to deduct all that, except for a few things. If you have to throw the IRS a bone, you have to throw the IRS a bone and say, hey, we didn't deduct these things, but we're going to deduct all the rest of these under 471C. So that's at the service level. That's at the client-facing level. If you're a wholesaler, if you're a cultivator, you don't have to worry about it as much. It's cultivation, most everything is going into the production good, and therefore that is all cost of goods sold, and therefore it's all deducted. But very overhead things like advertising, professional fees, definitely not deductible. Insurance, you can probably can maybe deduct that if we want to. Discretionary, if it's not required for a transaction, then those are the things that you may want to continue to disallow on attachments when you get there. But I would say go for it. Like I said, there's a lot coming down the pipe with Trulieve, these big MSOs, these other big cannabis companies that are refusing to pay tax on 280E, that are filing amendments for refund. Yeah. No, I don't have anything there. Yeah, so again, come to our booth and pick up one of these. It just this outlines pretty much everything that I just said. Not necessarily the federal aspect of it, not necessarily the constitutionality of the Controlled Substances Act and its implications on states with their own drug policies. That is quickly evolving right now. We are amending tax returns. If you guys know anybody in the cannabis industry, especially dispensaries, we are amending tax returns for refunds. We are moving forward in the cannabis industry without taking into consideration 280E. We do have very expensive. We hired an attorney and they wrote us a lot of legal jargon to include in tax returns in order to not, because we don't believe there's many things, a culmination of things that would say that the Controlled Substances Acts on states with legal programs is unconstitutional. And I think that's going to happen in the next 3 years or something like that. It's going to take a little while. Until then, the psychedelics industry should probably fall back on now what would be considered a conservative approach, which is 471C, or this bifurcation model where you separate services from the trafficking aspect of it. Just be careful who you're getting your advice from, because there's people who have not had any experience with 280E that are saying they're psychedelic accountants. There's cannabis people who are saying we can do 280E when they haven't really done much in the psychedelic space. And most people are not being aggressive at all, taking any methodology, and they're just sorry, you don't get the deductions. And that's what their advice is, and that's bad advice. Because really it's not the IRS that's creating this terrible tax debt, it's the accountants. that file these overly conservative tax returns and then put their clients into tax debt. That cannot be undone. All right, that's it. Do you guys have any questions?
Yeah. So, what about the farm bill that are selling things that are not?
Oh boy, the farm bill, THCA.
Yeah.
That's interesting.
Deduct all their costs.
Oh yeah, it's according to the farm bill, THCA is totally legal, and you can sell it in you can sell it in gas stations and then markets. No, a lot of them don't have like child-proof packaging, no testing. You can sell THCA across the United States. I think the states have like their own hemp laws in the behind, and they should be probably cracking down on THCA. Be careful, and no offense if you're in the industry. Like if you're a responsible grower in the hemp industry and you're selling essentially marijuana, across state lines. I mean, you're not subject to ADA for that. Because the hemp bill, THCA is just marijuana that hasn't been combusted yet. So you light THCA, you've got THC. So until it's THC, it's totally legal according to the Farm Bill. It's only the states that have like their own hemp regulation that will like knock that down. Like in Oregon, we have a total THC policy. So if you're growing THCA, that's over the 0.3 limit, 0.3% limit, then you're in violation of their hemp rules. But like Missouri is totally protecting. Florida, Texas, you can grow THCA there, no problem. And then you just gotta be careful what state you're selling it. All right, that's it.